Has Microsoft's artificial intelligence strategy become too expensive for its own good? The company is at the center of a multi-hundred-billion-dollar AI spending spree, yet its stock has fallen behind. Over the past month, shares have declined by double digits, raising a key question: why are investors getting cold feet just as the AI arms race heats up? This week, we're digging into the massive capital commitments, the market's surprising reaction, and the growing regulatory clouds gathering over Redmond. Welcome to TickerWatch News for Microsoft, Week 7, 2026. This is the weekly report where we track the signals and stories shaping one of the world's most influential companies. This week, the narrative is dominated by a paradox. Record-breaking investment in AI infrastructure is being met with significant investor concern, putting pressure on the stock just as the company solidifies its central role in the next generation of technology. It was a period of consolidation and reassessment for Microsoft shares. The stock ended the week around the $401 to $404 mark, reflecting a notable downturn over the past month. Shares have posted a decline of roughly 12 to 15% over the last 30 days. Year-to-date, the performance shows a similar 15% decline. This contrasts with the broader S&P 500 composite, which saw a much smaller 2% dip over the same month. Microsoft has also underperformed the wider computer software industry, which lost about 18% in the same timeframe. The quick takeaway is that after significant gains in previous years, Microsoft stock is taking a breather. Investors are weighing the company's aggressive long-term AI strategy with short-term pressures on spending and profitability. The biggest story of the week revolves around capital expenditure. Microsoft, alongside peers like Amazon, Google, and Meta, is part of an unprecedented AI infrastructure build-out. Projections show these tech giants could spend a combined total of more than $650 billion in 2026. Microsoft's own spending has accelerated, with reports of a $37.5 billion outlay in a single quarter, putting it on an annualized pace of over $140 billion. This investment is aimed at building the data centers, servers, and processing power needed for its Azure cloud service and AI ambitions. While the investment signals confidence in future demand, it has spooked the market. The sheer scale of the spending has raised questions about the impact on profit margins and free cash flow, contributing directly to the stock's recent decline. Adding to the pressure, regulatory scrutiny is intensifying. The U.S. Federal Trade Commission is reportedly escalating an investigation into Microsoft's business practices in cloud computing and AI artificial intelligence. The agency has sought information from Microsoft's rivals regarding its software licensing and the bundling of AI tools like Copilot with its dominant Windows and Office products. The probe appears to be examining whether Microsoft's practices make it difficult for customers to switch to competing cloud platforms, potentially stifling competition. This development adds a layer of regulatory risk on top of the financial concerns. In the midst of these challenges, Microsoft is also making strategic moves to diversify its AI ecosystem. The company is reportedly building its own powerful in-house AI models to achieve what its AI chief called true self-sufficiency and reduce its dependence on partner OpenAI. At the same time, it's deepening other alliances. Microsoft was a key participant in AI startup Anthropic's recent $30 billion funding round and announced a broad partnership with consulting firm Capgemini to deliver sovereign cloud services to governments and other regulated industries. The company also signed a $9.7 billion contract with Iron to secure AI infrastructure services, positioning itself as both a provider and a major consumer of AI capacity. Finally, a significant external threat came into focus. A memo from Microsoft's key partner, OpenAI, to U.S. lawmakers warned that a Chinese rival, DeepSeek, is allegedly using sophisticated methods to copy outputs from leading American AI systems. This practice, known as distillation, allows competitors to free ride on billions of dollars in U.S. research and development. This raises not only competitive business risks for subscription-based services like those from Microsoft, but also national security concerns about the erosion of the U.S. lead in AI. The market's reaction to Microsoft's spending plans and recent performance has been decidedly mixed, leaning toward caution. Several Wall Street analysts adjusted their views this week. Stifel and Melius both downgraded the stock to hold, citing concerns that the heavy capital expenditures could be a headwind for margins and free cash flow. Prominent investor Chamath Palihapitiya also pointed out that Microsoft has been the worst-performing stock of the hyperscalers since the launch of ChatGPT in late 2022. However, not all sentiment is bearish. Analysts at Piper Sandler and Wedge framed the recent stock weakness as a buying opportunity, arguing that the market is underestimating the long-term growth story for the Azure cloud platform and AI monetization. HSBC also maintained a buy rating. Looking at institutional activity, fillings showed that Al Gore's Generation Investment Management reduced its stake in Microsoft. On the other hand, the company remains a top holding in funds like the Liberty All-Star Equity and Growth Funds, where it represents a significant portion of the portfolio. The overall news narrative has been one of consolidation and questioning, with investors trying to balance Microsoft's undeniable leadership in AI with the very real costs of maintaining that position. From a technical perspective, the recent sell-off has pushed Microsoft stock below its 200-day moving average, a key indicator of a potential shift in the longer-term trend. The stock has found some footing in a price zone that corresponds to a large earnings gap from early 2025, which can sometimes act as a support level. For now, the short-term trend remains pointed down. From a fundamental side, the valuation debate is central. With a consensus analyst price target near $596, the current price around $401 suggests significant upside potential. Some fair value models also suggest the stock is trading below its intrinsic worth. However, other valuation metrics, like its price-to-sales ratio, indicate it still trades at a premium to its peers, reflecting the high growth expectations already priced in. The core narrative is a battle between growth and risk. The growth story is powered by strong earnings projections for the fiscal year and clear momentum in AI adoption, highlighted by the 15 million paid seats for Microsoft 365 Copilot. The risk story is dominated by the massive capital spending, pressure on profit margins, intensifying competition from Google and others, and the new regulatory overhang from the FTC. Looking ahead, there are no major company-specific catalysts like earnings scheduled for the immediate upcoming week. However, investors will be closely watching for any further developments related to the FTC's investigation into the company's cloud and AI practices. Commentary from competitors and peers about AI spending and demand will also be influential. From a price perspective, a key level to monitor will be the 200-day moving average. A sustained move back above that level could signal that the recent downturn is over. The recent lows around the $401 mark will serve as a near-term support level. Looking at potential scenarios, the bull case is that the market begins to view the heavy spending as a necessary investment for long-term dominance, and Azure's growth re-accelerates as supply issues are resolved. In this scenario, the stock would likely rally. The bear case is spending concerns persist, cash flow is squeezed, and the FTC investigation results in penalties or restrictions. This could cause the stock to drift lower. The base case is continued consolidation, with the stock trading in a range as the market waits for more clarity on a return on its massive AI investments. That's all for this edition of TickerWatch News for Microsoft, Week 7, 2026. Thanks for tuning in. Please remember, this podcast is for educational and informational purposes only and is not intended as financial advice. If you found this episode helpful, please consider subscribing, leaving a review, or sharing it with a colleague. Join us again next week for another look at the news moving Microsoft.